Welcome to the Strategic Investor. Join us as we interview some of the world's... Here is your host, Charlie Wright.
Hello and welcome to Strategic Investor Radio on OC Talk Radio, where we bring you investment strategies you are not hearing elsewhere. We'd like to welcome back to the show Jeffrey Hirsch, publisher of the Stock Traders Almanac and Chief Marketing Strategist at Probabilities Fund. He speaks to us from the headquarters in White Plains, New York. Jeff, welcome back to Strategic Investor Radio.
Great to be with you again, Charlie.
So, Jeff, I'm sitting here thumbing through the 2021 issue, which is the 54th issue of Stock Traders Almanac. So you are much older than you look, Jeff, I tell you, buddy. Okay.
I don't look 54?
You started at a very early age, huh?
Well, there was this other guy, my father, who started it.
Your father started. That is great. So welcome. Great to have you. Let me throw out a couple of things from the Stock Traders Almanac to get us started here. Since 1950, the Dow has gained 20,000 points during the November through April period each year, but only 4,000 points, again, 20, during the May through October period of the year. Number two, the January barometer is an accurate rate of over 87% of the time over the last 70 years. And number three, the S&P 500 shows that Mondays have been the worst days to invest to close higher than the previous day, but Wednesdays and Thursdays are the best. Now, Stock Traders Almanac is the source for all of that. It's fascinating stuff. So let's start with a brief background of yours and especially of the Stock Traders Almanac here.
Well, as I said, my illustrious father, Yale Hirsch, started this publication, this business back in 1966, the year I was born. So I was basically born, bred, weaned, raised, and trained on market seasonality, cycles, and trends. I took it over from him in about 2000, 2001. I had been working with him since 1990. And, he's 97 now. I see him weekly at the nursing home. But we've stood on his shoulders and built some new things on top of his work. And I had the privilege of learning how to do this research by hand with an adding machine and graph paper, and then brought it into Excel for DOS back in 92, and then Windows 3.1. And now my partner, Chris Mistel, Director of Research, has some software built for us so we can go in there and query it and come up with new things. So that we have a newsletter at stocktradersalmanac.com. We pick stocks using seasonals, fundamentals, technicals. We have sector rotation strategy. And of course, we send out alerts for that best and worst 6 months switching strategy that you alluded to, using a little MACD timing on there to get in and out at better times.
Okay, Jeff, if anybody would like to quickly pass a couple to 3 or 4 hours, all you'd have to do is pick this Stock Traders Almanac up and start thumbing through it. It is fascinating stuff. So what do you find that you're able to see here that people not familiar with it are not able to see?
Well, I mean, I would advise not to try to read the whole thing in one clip. Each page
question about that
information. You could, if depending upon the time of year you get it, you could start right in the current year, look at what's going on this week, what's going on this month, looking at, say, the March Almanac, for example, and the middle of the month, the triple witching of end of Q1 is coming up. Week after triple witching is pretty difficult, but starting, currently where we are on the calendar, I mean, that's how the book was built, so that you can follow the market schedule along with your own. And then I advise people to go look at the table of contents, familiarize yourself with what's in it. This is the post-election year edition. We've got particular pages geared towards the post-election year, which historically has been a weak year for the market, but has improved somewhat the past couple of decades. And with a new Democrat in the White House, as well as a Democratically controlled Congress, we've had some pretty good returns the last 4 times. I know it's only 4, a small amount, but that's some of the things you look at. And then, you get into the intro so you can see how to work the book. And I also advise people to jump to the back. There's some of the things about how to invest, with Gerald Loeb's Ruling Reasons and Battle for Investment Survival and that sort of stuff back on page, 192 and 191.
So Jeff, I'm sure one of the questions that you often ask, and when I talk about these kinds of things with clients, they almost always bring it up, is, headline news runs much of the market these days, especially on a daily basis. Not nearly as much, obviously, weekly and certainly monthly, but on a daily basis. So how do you reconcile investing in early March or in October or something with the fact that it's headline news driven, and yet you're looking back 80 years or some period of time? And how do those two things reconcile here?
Well, first off, we don't just look back 80 years. We look at several different time frames. We look back 80 years, 30 years, 31 years, 21 years. We're always looking at the most recent, like 20, 21-year time frame to keep things in check. Sometimes shorter time frames depending upon the pattern. But I would contend that the market isn't just run by headlines. Yes, intraday, daily it does, but the ALMANAC is built on the belief and the proof that people behave repeatedly in the same fashion with their money. So you have, whether it's the intraday patterns, despite high frequency trading and algorithms, people tend to close secure positions or square positions around 2:30 after lunch, rallies to the close. You got different days of the week, people coming in to the beginning of the week. If there's problems, that they'll sell. And then you've got the monthly patterns, people paying their bills. And one of the things that we discovered using the monthly cash flows is that mid-month spike when the payroll deductions go into 401ks and IRAs, and money managers got to put that money to work. So I would contend behavioral finance is at play as much as headlines.
Great point. Really appreciate that. I have not caught that from the book here. So what would you say to someone who believes that they just don't buy into the whole idea of seasonality and patterns and the like?
Invest with another method, and we'd be happy to have all the skeptics we can, because that keeps people from front running it and lets the patterns play out. Seasonality exists. Everyone talks about it. Everyone sees what happens. We live in the northern hemisphere mostly, and we revolve around the different circadian rhythms and how people behave. You can see volume drying up in the summer. If you don't believe it, then there's other investing methods that work too. We subscribe to this, and it works for us. And also, if I may, it's not just to use those seasonal patterns in a vacuum. To overlay that with news. We're always looking at the monetary policy and current trends in the economy, as well as fundamentals, technicals, and of course market internals. New highs and new lows, advanced decline. So we're not just purely seasonal, but that's our foundation.
So Jeff, what would you say, looking at the past 10 years as opposed to the previous years, what could you say today that you couldn't have said or wouldn't have said 10 years ago?
I'm not sure 10 years is a long enough period of time. It's not necessarily statistically significant. I'm not sure a whole lot's changed. We've seen a little bit stronger behavior in the pre-election years. In the post-election years like this year. January's become a little bit weaker. We've seen that January break materialize a bit more, but in a news neutral environment, people are still behaving, with the seasonal behaviors that they have with summer vacations and holiday buying and paying bills monthly. So there's been a few things, but other than, COVID and black swan events, it's been persistent, and I'm kind of, humbled by it.
So let's talk for a minute about Fang Stocks. Okay, they have been the darlings really since about 2013, and they have accounted for such a significant portion of the S&P 500's performance. And I've seen lots of charts showing that the rest of the 490 plus S&P 500 participants have done very little really, in the last few years, and Fang stocks have just gone crazy. Would your book have picked up on that, or are they just plain market focused?
We have some sector work in there. So the sector seasonality is on tech stocks. We've benefited from some of that, as well as, our seasonal switching strategy. We use the QQQs. We use the NASDAQ as well. So we're getting a lot of that Fang juice in the market when we are in the best months. And the NASDAQ has a best 8 months from November through June. So that's in the book. There's a page about, the best 8 months for NASDAQ. I think it's page 56 if you got your book handy.
Yeah.
If memory serves. Wait a second. No, it's 60. That's the NASDAQ's best 8 months with MACD timing. And the numbers there are incredible. And some of our subscribers, they subscribe to the newsletter just for those two signals a year. And they'll switch in and out of the Qs or whatever other vehicle they're using to capitalize on that. So we've included the QQQ and Russell 2000 in our seasonal work, and in the other work we do in the newsletter. It's also part of the Probabilities Fund.
Okay, and the Russell 2000. Okay, and has that been a surprise according to your system over the past 3 or 4 months, the way it's performed, or not?
Well, the record, the November for the record book surprised a lot of people, but ironically, or at least not ironically, it correlates very well with small cap seasonality that really picks up around the turn of October and also after Thanksgiving, and even more so. So that's the seasonal time of year for the small caps. Remember the old January effect? Not the January barometer, the January effect. Small caps outperforming large caps in January. Well, that's rolled back a little bit, and most of that is in the last 2 weeks of December, and it really begins in earnest right after Halloween and in November. So surprised by the magnitude, sure, but by the outperformance in general over the market, not so much.
Okay, how about growth versus value? The value diehards have just been saying it's coming back, it's coming back. Do you guys get into that level of stuff?
Yeah, we do. I'm a growth guy, by makeup, by nature. But when we do our stock screens, we're looking for growth stocks. September, October, when that fourth quarter, that Q4 market magic kicks in, and then we look for some value during the weaker, worst 6 months, May through October. So when we run our stock screens, we look for value and growth combined. So we're looking for companies that have low PEs relative to the market, low price to sales ratios, as well as accelerating growth in revenue and earnings. Plus, they're off the radar, not followed by so many Wall Street analysts, as well as a technically sound picture when we get into the stocks.
Yeah. I've heard for a long time about how Russell 2000 is not followed as much by the analysts. It's interesting that more analysts haven't picked up on that and increased that. They've been saying that forever.
And it's really not a small cap index anymore. it's kind of more mid cap.
Yeah.
But it's still a great vehicle to trade.
Tell us a little about the Probabilities Fund. We had Joe Chaudhry, who is heading the fund, and together with you, and started it years ago. We had him on here several years ago. Talk to us about the Probabilities Fund.
Well, Probabilities Fund was inspired by the ALMANAC. A bunch of years ago, Joe was going on a trip. He was a broker, branch manager at A.G. Edwards. And he went to Africa, and he forgot his reading material and picked his old trusty ALMANAC up off the conference room table and brought it with him on a trip and read it pretty religiously for the next 14 days and came back and was inspired to create the system. Now, Probabilities Fund, we've developed a strategy a little bit more over the past several years since we've joined forces with him, but we trade the ETFs based upon the Dow, S&P, and NASDAQ, the diamond spiders and cubes, as I call them, using leverage based upon our calendar strategies, that the monthly cash flows that you see in the back of the book on page 146 and 7, as well as on the top of the Almanac pages, those the personality of each month really is kind of what drives our strategy, our leverage, and our bias. And it's a great alternative investment for people to include in their portfolio allocations.
Okay, and it must be a significant challenge. I remember Joe telling us the story, and again, this was probably 5 years ago, that whenever Congress has a special session, that is one of the worst possible days for the stock market.
Well, Congress is important. They haven't done a whole lot the past bunch of years, as far as I'm concerned. Maybe we'll get some infrastructure bills this year, legislation, but we've actually found that the whole congressional effect has waned. I mean, I guess if you were your previous question about what's changed over the past 10 years, we're seeing that, when Congress in session, not really impacting the market as much as it used to back in the old days. So more, I think people's behavior with their money, on a regular basis, like the 401k, payroll deductions, and going on vacations and squaring positions at the end of the week, those kinds of things seem to impact the market a little bit more than Congress does these days in the short term.
Yeah. Have you seen much of an impact of the COVID pandemic in people's investment behavior?
Investment behavior, yes, but I've seen it impact seasonality. I mean, people have had a lot less to do except sit there and watch the market. So it's been a little bit more volatile. Some things like the whole GameStop Robinhood thing, which I think is pretty much old school stock manipulation, and they'll probably get a little comeuppance on that from my vantage point. But it did knock seasonality off its track from about March through August, as we were fighting lockdowns and economic pressures, as well as the big bounce back after the sell-off there in March. And then about September, we got back on track with seasonals, and we had a very typical week end of third quarter. September is one of the worst month of the market. We had another correction there at the end of October, very seasonally typical. Luckily, or nicely on the charts, technically that October low is a little bit higher than the September low. I see a nice trend line support there. We could go deep into some technicals. I happen to be a little bit of a chartist at some level. But COVID basically trumped, no pun intended, seasonality for about 6 months or so, maybe 4 or 5 months.
So, Jeff, let's go back to Stock Traders Almanac. For those who would like to know more, where can they go?
Pretty simple, stocktradersalmanac.com. You can probably type it into Google and it'll get you there. But that's the place to go. Amazon sells the books, but you can get them from us as well. Okay.
And for Probabilities Fund, what does one do?
Probabilitiesfund.com. It's all right there. And I can tell you that with the newsletter subscription, people get a free copy of the Almanac every year. So it's quite a deal.
Yeah, it is. Okay. So tell us, what keeps you awake at night? We ask each of our guests that question here, Jeff. What is it besides your son here? You would tell us. And his computer games here.
I don't know. Just market seasonality, thinking about what I got to do the next day. We have a system. I've learned one of the things that used to keep me up at night was, emotional concerns about the market. I think that's one of the most important things people need to get a handle on, is their emotions, and go against their human instincts, and sell their losers fast, to let their winners ride, and stick to your systems and your stops and your buy limits, and try to be robotic about it, and not get too emotional. I mean, if you like a stock because of some products or something you've read, use Gerald Loeb's Battle for Investment Survival, the checklist, and have a ruling reason and stick to it. So I think checking emotions at the door is the hardest part of investing and trading.
Yeah, people have been telling me that for years, and at first I thought, they're not right. I'm not an emotional guy, but the older I get and the longer I'm in it, I realize that is not the case.
I've learned a few emotional lessons myself in the market as well.
Yeah. So, Jeff, how about some final words for our listeners here? Some sage advice here.
Well, let's just talk about this year. I mean, we had down January, which, every single down January since 1950 has been followed by a 10% correction, a bear market, a newer continuing bear market, or a flat year. NASDAQ 100, the NDX almost had just about a 10% correction already.
Right.
So that's something to consider. But, we've stood on Yale's shoulders and combined his Santa Claus rally, which he invented back in 72, along with the January barometer and the first 5 days early warning indicator. We call it the January indicator trifecta. So we had 2 out of 3, which is encouraging. If it was 3 for 3, that's really encouraging. When it's 3 for 3, you get the year, like a 27 out of the last 31 years were up. And then here we are in March. Watch out for the end of the third quarter. There's some selling pressures there, as well as the week after triple witching. And I would suspect some weakness over the worst 6 months, May through October, flat to weak with some corrections. But I think we're going to close out the year, towards our best and base case scenarios, maybe about 4,200, 4,300 S&P, give or take a little bit.
Would you factor in the stimulus? It looks like it's coming any day.
I think some of it's already factored in. The market's an anticipating mechanism. If the vaccine roll out and everyone gets shots in their arms and people start getting back to regular work, we might even be a higher than that. Those numbers I just threw out there, and we might not have much of a correction in the summer months. But people are going to start going away end of August. Early September, third quarter, triple witching, that might be a good time for a little correction. Nothing sinister. I'm not looking for a bear market, but maybe 5-10% or so, depending upon the index.
Okay. Well, Jeff, this has been fascinating. Any of our audience that fell asleep during this, it is their fault, because you guys have the stats, and it is very interesting stuff. And we really appreciate you coming on with us, and offer our best wishes for your continued success with both the Stock Traders Almanac and Probabilities Fund. So good luck, and thanks for being with us here today. Thanks again, Charlie. A lot of fun. So again, you've been listening to Strategic Investor Radio on OC Talk Radio, and we'd love to hear from you at info@strategicinvestorradio.com. You can access any and all of our previous interviews and shows at strategicinvestorradio.com. I'm Charlie Wright, wishing you an enjoyable week and productive investing.
Welcome to the Strategic Investor.
Strategic Investor Radio is a production of OC Talk Radio and is provided for educational purposes only. Content of this program and the views of the guests should not be considered as recommendations by OC Talk Radio or investment advice from the host Charlie Wright or any other entity attached to this production. Investors should always consult qualified financial, investment, tax, or legal professionals prior to investing. Okay, that's how we do. You see what you did, Charlie? Now you threw me off there. It's all your fault.
So you're the only one